If you're buying or selling real estate in 2026, the old playbook will not work. The market is really shifting again, and the strategies that worked during the low rate frenzy are no longer universally effective. And what I'm seeing is that many people are still approaching this market based on assumptions from a completely different environment. And that creates mistakes. Buyers overpay, sellers overprice, and people wait for conditions that may, in reality, never return. And most importantly, many people misunderstand where leverage actually exists right now. So in this video, I want to break down the biggest real estate trends shaping 2026, what they actually mean, and how buyers and sellers should think strategically moving forward. My name is Bent Danholm. I am a broker and owner of Danholm Collection here in Central Florida. A very large part of what we do is we help buyers and sellers make strategic real estate decisions based on actual market dynamics, not on headlines, not on emotion, and not on generalized national narratives. And right now, strategy matters more than it has for years. Because this market, 2026 market, is no longer being driven by easy money and emotional urgency. The market is becoming a market driven by discipline, positioning, leverage, and execution. And that changes how buyers and sellers need to operate. So let's start with the obvious one, the elephant in the room, the interest rates. Rates continue to shape buyer behavior more than almost anything else in the market, not just financially, but also psychologically. And that distinction matters. Because when rates rise, buyers immediately focus on the monthly payment. And that's really very understandable. But what people fail to recognize is that rates influence competition just as much as they influence affordability. When rates remain elevated, like you could say they are now, some buyers pause, causing demand to slow and properties to sit longer, and actually leverage negotiation a lot for the active buyers that are left in the market. When rates fall, a lot of buyers re-enter the market, causing competition to increase and causing leverage to shift back towards the sellers. And prices often rise alongside demand, and quite often a lot more than the rate reduction really justifies. That is why analyzing rates in isolation creates incomplete decisions. A lower rate does not automatically create a buying environment that's better than it was before. Sometimes it creates, and most times it creates, a far more competitive environment. And that is one of the biggest misunderstandings in today's market. Rates influence behavior more than they influence fundamentals. Strategic buyers understand that leverage matters just as much as financing. Strategic sellers understand that you have to price your home strategically and market directly to the buyers who are most likely to pay the most for your home. So you regain some of that negotiation power you had when rates were low. And it didn't really matter how you marketed your house. You were still going to get $150,000 more for your home than it was actually worth. But now your strategy matters. When all that is said, in my opinion, inventory, on the other hand, is still the most important metric in real estate right now. Because inventory largely determines leverage. It determines competition, it determines pricing pressure, it determines negotiation power. And one of the biggest mistakes I see people make is treating real estate as a single national market. It really isn't. Real estate is probably more microeconomic than anything else. Prices and market conditions can vary almost from street to street. Some areas are still heavily supply constrained. Other areas are seeing inventory rise significantly. Most luxury markets remained resilient because affluent buyers are less rate sensitive. A lot of them pay cash. Other price points are seeing much more pressure than the luxury end of the market. And that is exactly why local market analysis matters more than broad national headlines. The national media may tell you one story, but your actual neighborhood you're either selling or buying in may be telling you a completely different story. And that's especially true here in Florida, where migration patterns, lifestyle relocation, tax advantages, and new construction all impact supply and demand differently depending on the area. And inventory changes strategy. When inventory rises, buyers gain leverage, sellers lose pricing power, and preparation becomes critical for sellers. When inventory remains constrained, competition intensifies, pricing remains stronger, and buyers lose flexibility, so preparation becomes critical for buyers. So, if you're trying to understand where the market is headed, watch inventory first, because inventory usually tells you where leverage is moving before any of the headlines do. Another major shift in 2026 is the normalization of appreciation. The rapid appreciation we saw during the pandemic years was very abnormal. It was historically abnormal. And many people became conditioned to believe that home prices simply move aggressively upward all the time, like a rocket out of Cape Canaveral almost. That is not how healthy markets typically function. Now, that does not automatically mean that prices are collapsing. In most places, they're not. I don't actually, off the top of my head, know of any places where they're actually collapsing. What we're really seeing is normalization in most areas, and especially in the high end of the market. We're seeing a little bit of a slower appreciation, but it's still an appreciation. We're seeing a little bit of a selective softening, but it's definitely not a crash or a downward trend. We see stabilization. We're seeing stabilization. You're seeing a market that is going back to what it's supposed to be. Yes, there's some pressure in overbuilt segments, though. And there's a lot of strength in supply constrained areas. But broadly speaking, this is no longer an environment where almost every property automatically gains value quickly, regardless of positioning or presentation. And that changes behavior. Buyers become more analytic, and sellers need to be more strategic. Pricing strategy and marketing becomes crucial. The era of automatic appreciation is largely over, and that means sellers can no longer rely on the market alone to create leverage. They need proper positioning. And one of the biggest shifts happening right now is the return of some negotiation leverage for buyers. And a lot of buyers do not fully recognize that. So you can take that for a little while still, sellers. For several years, buyers operated in extremely aggressive conditions. They waived contingencies, they were up against multiple offers, there were bidding wars, they had to limit inspections, they had to take minimal or no concessions. And that environment created urgency-driven decision-making. You were deciding based on your immediate emotions, not on analysis, because there was no time to make analysis. Today, in many markets, buyers are regaining negotiation power. Not everywhere, but in many areas. That means that buyers may now have opportunities to negotiate. They could maybe negotiate on closing cost credits, getting more repairs done that they could before. They could maybe get the price reduced. Maybe if they're financing, negotiate rate buy downs. Get flexible timelines that work better with their timeline and not strictly on the seller's timeline. And generally get stronger terms overall. And that really matters. It matters for both buyers and sellers. It matters for sellers to know that this is where the market is right now. And it matters for buyers to know that they have these options. Because that leverage changes the entire acquisition strategy and selling strategy for that matter. High interest rate markets are often negotiation markets. And disciplined buyers can create substantial long-term value during periods where competition softens. The best buying conditions rarely exist when the headlines feel comfortable. And this, I think, is a really important concept to understand, because buyers who wait exclusively for lower rates may end up entering a far more competitive environment later. And that's probably where I see the biggest disconnect right now. Many sellers are still anchored to yesterday's markets. They're pricing based on peak conditions, peak emotions, peak urgency. No need for marketing, just put the house out there, overpriced, and it'll sell. But you need to know, if you're selling, that buyers have become way more selective. And as inventory rises in many markets, sellers lose the ability to rely on scarcity alone. And that means that strategy matters again. Your pricing strategy matters again. Your presentation strategy matters again. Your marketing strategy matters again. Your preparation matters again. And the quality of all that matters again. Exposure alone is no longer enough. Putting it in the MLS or on Zillow is no longer enough. Simply putting a property online and waiting is not a market strategy, and it definitely doesn't work right now. What the market does reward right now is homes that are properly positioned, strategically priced, they may even see multiple offers, well prepared, and marketed toward the right buyer profile, the latter being probably the most important of it. And that's a major distinction. Broad exposure creates visibility. Target marketing creates qualified demand. And that's, if you're selling your home, you're really not interested in a million people seeing your home. You're interested in the 50 or 75 most likely people to buy your home, to seeing it and wanting and fight over your home. That's what you're looking for. At Dan Home Collection, a large part of our strategy centers on identifying the most likely buyer for a property and tailoring the marketing to that audience, both in terms of what we do in marketing and where we position that marketing and how we present it to those buyers. And that's because different properties appeal to different buyer profiles. And in a market where buyers are becoming much more selective, strategic positioning becomes increasingly important. This is no longer a market where weak execution gets hidden by excessive demand. Now, despite all the noise, opportunities still exist for both buyers and sellers. In fact, strategic markets often create some of the best opportunities. Like I said, buyers may have more negotiation leverage, more time to evaluate decisions, and stronger ability to structure favorable terms. And sellers who understand the market and adapt appropriately can still perform extremely well, especially if their pricing is strategically disciplined, their preparation is strong, and their marketing is targeted and strategically. Long-term housing demand still exists. People are still relocating. Families continue to grow. Lifestyle shifts continue to happen. Business growth continues. Migration into Florida continues. We're still a no income tax state. The market has changed. The activity has changed, but it has not disappeared. The key difference here is that this market rewards discipline more than speed. And that this is actually a healthier market dynamic overall than we used to have. The biggest mistake that buyers and sellers can make in 2026 is to assume that the market still behaves the way it did a few years ago. It doesn't. It's a more strategic market. It's a more disciplined market. It's a market where leverage shifts faster, pricing matters more, and preparation has greater impact, whether you're a buyer or seller. Some buyers will wait too long because they're focused entirely on the headlines. Some sellers will chase pricing that no longer reflects current conditions. But the buyers and sellers who win in this market are the ones that adapt quickly and position themselves properly. Those are usually the people who perform best. If you're planning to buy or sell this year, focus less on broad headlines and more on your specific market, your leverage position, and your long-term strategy. Because the right move is rarely determined by one national headline or one interest rate number. It is truly determined by positioning, timing, preparation, and execution. If you want help analyzing your specific situation, feel free to reach out or leave a comment below. Thank you so much for watching, and I hope to see you in the next video. Bye for now.